Welcome to the CoreLogic RP Data update on housing market conditions for November 2014, brought to you by Smartline Personal Mortgage Advisors. Housing market conditions remain slanted towards Sydney and Melbourne in October, with values in these two cities rising by 1.3% and 1.9% respectively over the month. Brisbane was the only other capital city housing market that recorded a capital gain over the month, with dwelling values across Australia's third largest city rising by 0.6%. Australia's three largest capital cities pushed the overall combined capital city index 1% higher in October, taking the cumulative rate of growth to 20% since values started the upwards trajectory back in June 2012. Over the rolling quarter to the end of October, capital city dwelling values were 2.2% higher, and over the past 12 months we've recorded an 8.9% rise in capital city dwelling values. Every capital city has seen values move higher over the year, led by Sydney with a 13.1% capital gain over the year, and Melbourne where values are 8.9% higher. The slimmest rate of growth over the year was in Canberra, where values are virtually unchanged with a 0.9% capital gain. The previously strong conditions in Perth have continued to wind down, with the annual rate of capital gain tapering to just 3.4% over the year. Even though capital city dwelling values continue their strong growth conditions, at least at the combined capital cities level, the pace of growth has been slowing since reaching a recent peak of annual growth at 11.5% over the 12 months ending April 2014. Since that time, the annual rate of growth has slowed to 8.9%. The moderation in capital gains has been accompanied by a levelling in the number of dwelling sales. Nationally, over 3 months to the end of August this year, there were approximately 117,000 house and apartment sales, which is 0.7% lower compared with the same period a year ago. There has been a similar slowdown in housing finance commitments, with the number of new owner-occupier housing loans broadly flat over the year. The slowdown in mortgage demand is arguably the best lead indicator for the number of home sales. Despite the apparent slowdown in buyer demand, there's only been a modest slide in auction clearance rates. Over the past 4 weeks, the average auction clearance rate across the capital cities has been about 69%, down from 72% at the end of September. The two largest auction markets, Sydney and Melbourne, have also been recording slightly lower clearance rates over the past 4 weeks. In contrast, private treaty measures through to the end of September have shown a slight improvement, as they've historically done during the spring season. The average number of days it takes to sell a house fell from 43 days to 39 days in September across the combined capital cities. Sydney and Melbourne continue to show the fastest average selling times at 29 days and 40 days respectively. Vendor discounting rates have remained at 5.5% over the month, which is well below the long-term average. With the spring selling season now well underway, we can see that the number of newly advertised properties is quickly ramping up. Across the capital cities, the number of new listings added to the market is almost 8% higher than a year ago. Despite the solid rise in newly advertised homes being added to the market, the total number of properties available for sale remains 4.5% lower than at the same time last year. The short effective supply levels are one of the key factors driving dwelling prices higher. Let's have a look at the housing market conditions across each of the capital cities. Sydney is continuing to dominate the capital gains across Australia, with dwelling values rising 3.9% over the past 3 months. The housing market in Sydney remains well in favour of sellers, with homes averaging just 28 days to sell and vendors discounting their prices by a slim margin of just 5.1% on average. Stock levels remain 7% lower than a year ago, highlighting the rapid rate of absorption across this very hot market. Melbourne recorded the highest month-on-month capital gain of any capital city in October, with dwelling values rising 1.9% over the 3-month period. The substantial jump over the month is mostly catch-up from previously low month-on-month capital gains. Rental prices across Melbourne have hardly moved over the year, up by just 2.5%. The low rate of rental appreciation, together with a strong capital gain, has compressed rental yields to the lowest level of any capital city, with a typical Melbourne house now providing a gross return of 3.2% and apartments showing a 4.1% gross return on average. Brisbane's housing market appears to be gathering some pace, with dwelling values up 0.6% in October, taking the annual capital gain to 5.6%, which is the third highest rate of growth across the capital city markets. Year-on-year transaction volumes are 19.5% higher, indicating stronger buyer demand, and gross rental yields are the third highest across the capital city markets after Darwin and Hobart. Adelaide values took a hit in October, with the CoreLogic RP Data index down 1.1% over the month for Adelaide. Despite the October fall, the past 3 months has seen Adelaide dwelling values rise by 2.1% and values are 4.3% higher over the past 12 months. Buyer demand is on the rise, with year-on-year transaction numbers 9.1% higher than a year ago. Perth's housing market has continued to wind down, with growth conditions peaking late last year. Values were virtually flat over the month of October, but down 0.2% over the past 3 months. The annual rate of capital gain has slipped from a recent peak of 9.9% in December last year to 3.4% over the 12 months to the end of October this year. Weekly rents are down 3.1% over the past year, and transaction numbers are also lower, down 4% year on year in Perth. The upwards trend in Hobart dwelling values has been interrupted, with dwelling values shifting almost 3% lower over the past 3 months. Dwelling values are 4.1% higher over the year though, and Hobart rental yields are the second highest of any capital city after Darwin, with both houses and apartments typically returning a gross yield of 5.4%. Another positive sign for the Hobart housing market is the substantial bounce back in housing market demand. Transaction numbers are 17% higher year on year as buyers become more active. The northernmost capital city housing market seems to be slowing down. Darwin's housing market has recorded a 1.7% drop in dwelling values over the past 3 months, taking the annual rate of capital gain to just 5%. Transaction numbers are roughly level with the same time last year, and weekly rents have posted their first annual fall since late 2011. In the national capital, Canberra's housing market has been trending towards softer conditions. Dwelling values were 2.4% lower over the past 3 months, and the annual rate of capital gain is just 0.9%, which is the lowest of any capital city. Additionally, weekly rents are down by 4.9% over the past year, and transaction numbers are approximately 8% lower over the past year compared with 2013. The spring season is providing some reasonably strong housing market conditions across the 3 largest capital cities, with Sydney and Melbourne continuing to lead the nation for capital gains. When we drill down to individual markets, the diversity of the housing market becomes very clear. The Perth market, Canberra and Darwin appear to have moved through the peak of their growth cycles now, while other indicators suggest that some heat may be starting to leave the Sydney and Melbourne markets. Buyer demand is improving across Brisbane and Adelaide and Hobart, where the capital gains cycle is still very immature. The latest interest rate decision from the Reserve Bank makes it clear that interest rates are likely to remain stable for the foreseeable future, which will continue to keep a floor under housing demand. The latest statement from the Reserve Bank suggests that the bank is relatively comfortable with the gradual moderation in the rate of capital gains. However, there remains some concern about the level of investment in the housing market. Based on housing finance commitments data, investors now comprise 49.7% of the new mortgage market. In New South Wales, the proportion is substantially higher at 59.2%, while investors account for 53.9% of the Northern Territory's new home loans and 49.7% of Victoria's new home loan commitments. Investors may already be feeling a bit uncomfortable with the heat in the market and the recent Reserve Bank warnings. While investment in the housing market continues to grow, the rate of increase in the value of investor mortgage commitments has slowed from a recent peak of 40% annually in December last year to approximately 28% in August this year. If APRA introduces macroprudential measures to cool investor demand, as is widely expected before the end of the year, we're likely to see investor demand slow further as the cost of debt rises in response to regulatory changes implemented by APRA. In the meantime, we may actually see a lift in investor mortgage demand as some investors look to beat the potential introduction of these macroprudential tools into the market. Thanks once again for tuning into CoreLogic RP Data's Housing Market Update. You can find more housing market information at our website and research blog located at www.rpdata.com.